Welcome to The Explainer. Today, we're talking about a day of absolute chaos in the financial world. And it was all kicked off by just one number. A single, shocking number. And here it is, 22,000, that's it. That's the number of jobs the U.S. economy supposedly added in August. And let me tell you, the second that number hit the wires, the entire financial system just went into a total frenzy. So, to give you some perspective here, economists, the experts, they were expecting something like 75,000 jobs. What we got wasn't even close. It wasn't just a miss, it was a massive whiff, less than a third of what was forecast. That's a huge red flag that the job market is seriously sputtering. And oh, it gets worse. The bad news just kept on coming. The unemployment rate, it ticked up to its highest point since late 2021. And then they went back and looked at the numbers from previous months and revised them down. It turns out June wasn't just weak, it was a net job loss, the first time that's happened in years. So the big takeaway here is that the job market was way weaker than anyone had realized. All right, let's get into the really weird part. You'd think, right? A stalling job market, rising unemployment, that should be absolutely terrible for stocks. I mean, it's bad news for the economy. But as the day went on, something completely counterintuitive happened. You could almost hear the alarm bells going off all over Wall Street. I love this quote from Glassdoor's chief economist. He said the job market is stalling short of the runway. What a visual. It perfectly captures that feeling, that fear, that the economy wasn't in for a soft landing, but was about to crash and burn. So here's the big question, the central paradox of the whole day. If the economy's engine is sputtering out, why on earth did the stock market suddenly rally to all-time highs? Why did investors slam on the gas? Well, the answer comes down to one institution, the only one powerful enough to change the game, the Federal Reserve. And here's the key thing to understand. Wall Street wasn't celebrating a weak economy. No way. They were celebrating the promise of cheaper money. See, the logic goes like this. Bad news is good news. A struggling job market basically forces the Fed's hand. They have to step in and cut interest rates to prop up the economy. And for the stock market, lower interest rates are like pure rocket fuel. And wow, did traders react fast, like lightning fast. Before this report came out, a Fed rate cut was, likely, a good possibility. After, it was a done deal, a 100% certainty in their minds. They didn't just price in a cut, some started betting on a huge half-point cut. That's something that was basically off the table just the day before. All this volatility created this crazy split in the market. You had these huge winners and huge losers. Take Broadcom. Their stock just soared, up 10% on this fantastic news about a massive AI chip deal, supposedly with OpenAI. But then you look at a company like Lululemon, and it's a bloodbath. Their stock plummeted 18% on a weak outlook. It just goes to show how this one day pulled different parts of the market in totally opposite directions. But this whole story isn't just about the numbers in the markets. There's a whole other layer to this. A political storm was brewing right behind the economic data, a real battle over who gets to control these numbers and the policies that come from them. And if you look at the timeline, you can see this clear pattern of political pressure building. It really kicked off last month after another weak jobs report when the head of the Bureau of Labor Statistics, the agency that produces this data, was fired. Then there was an attempt to oust a Federal Reserve governor. And just this morning, President Trump called out the Fed chair, Jerome Powell, on social media for being too late. When you put it all together, it looks like a direct challenge to the independence of these crucial economic institutions. This quote from the Commerce Secretary, Howard Lutnick, really sums up the administration's view on this. He said, "You'll take out the people who are just trying to create noise against the president." I mean, listen to that phrasing. It suggests that the data will become more accurate by removing certain people. This completely reframes the whole situation, right? It's not about an economic problem that needs fixing, but a political narrative that needs managing. Okay, so we've talked about Wall Street, we've talked about Washington, D.C., but let's bring this home. How does all this high-level drama actually impact your money, your wallet? Well, the effects were felt almost immediately. Take a look at this number, 6.29%. By the end of this one chaotic day, that was the new average rate for a 30-year fixed mortgage. So what happened? Well, the market's big bet that the Fed was going to cut rates had a direct, real-world consequence. It drove down the cost of borrowing. It was actually the biggest one-day drop in mortgage rates we've seen in over a year, pushing them to their lowest level since last October. And here's why that really matters. Let's say you're buying a home. maybe taking out a $450,000 loan. The drop in rates on this one day could save you about $169 every single month. That's more than $2,000 a year back in your pocket, all because of the chain reaction started by that one jobs report. So, let's step back. We've got a weak economy, but a stock market that's weirdly optimistic. And all of this is happening under intense political pressure. So the big question is, what happens next? The signals are all over the place, pointing in completely different directions.
Well, first off, investors are getting ready for something called the September effect. It's this weird historical quirk where September is, for whatever reason, usually the worst month for the stock market. And this year, you can bet that normal seasonal anxiety is getting a huge extra dose of uncertainty.
So what are the pros the strategists saying you should do? The big word right now is caution. They're pointing out that almost all of the market's gains are coming from just a handful of huge tech stocks. That's a lot of eggs in one basket, which is risky. The advice? Maybe look beyond those big, flashy names. Consider some of the ignored sectors, defensive areas like healthcare, materials, or even small cap stocks that have kind of been left behind in this whole AI frenzy. Which brings us right back to this central dilemma of the day, doesn't it? You've got the economic data screaming that we're in trouble. You've got the stock market betting that a rescue is just around the corner. And then you have the political sphere questioning whether the data is even real. So in an economy with so many conflicting signals, who do you trust? The data, the markets, or the politicians? There's really no easy answer to that one.